everyone. Thank you so much for joining. This video is all about real versus nominal exchange rates. We are looking at real and nominal exchange rates because we want to understand how different price levels in different countries / inflation rates affect the underlying exchange rate. So if we look at nominal exchange rate here, nominal exchange rate, this is the exchange rate at which one currency can be exchanged for another in the foreign exchange market. It does not account for differences in price levels or inflation between countries. The real exchange rate here is, as you can see, because of this term, is adjusted for differences in inflation between two countries, and the real exchange rate reflects the relative purchasing power of one currency against another. Basically, it adjusts the nominal exchange rate for changes in each currency's relative purchasing power. So what you can buy in the end with your currency. Very important terminology. We have two currencies, currency D and currency F. Sometimes we say domestic or foreign. Doesn't really matter, because if you look at other currencies where you're not located in one or the other countries, it doesn't really matter. So here we could say we use for D US dollar and for F Australia, even though we are based in Europe, doesn't matter. The only thing that matters is that you stay consistent. And if you state your real exchange rate, currency D or currency A needs to be on top in the numerator. Currency F, foreign, or currency B or whatever needs to be in the denominator. Yeah, same for your nominal. And then when you type in your inflation numbers, it is the opposite. D is here, F is here. Sometimes very confusing, because we have another formula for relative purchasing power parity, which is ET in the future equals E0, exchange rate today, times 1 plus ID over 1 plus IF, where DF looks very, very similar, RPPP. However, here the currency is consistent, F currency here is consistent. Different concept, because there we are looking in the future, spot exchange rate today, inflation information, what do we expect the future exchange rate to be. This is not what we are looking for here. Here we are looking at the same point in time. So this is point in time now, and then the current inflation information that we have. So don't get confused if you see a similar formula, RPPP. It is similar, but your inflation rates are stated differently. Let's do an example. Let's assume the nominal exchange rate between US dollar and AUD is 0.65 US dollar per AUD. You could go to the bank or in foreign exchange markets, and you could trade 1 Australia dollar in exchange for 0.65 US dollar. This is the exchange rate. You can exchange US dollar for AUD and vice versa at this rate. If we, however, assume US has an inflation rate of 2% and Australia has an inflation rate of 10%, then we need to take inflation / purchasing power into consideration, because it's nice if you go to the bank and exchange 0.65 US dollar for AUD, but the question is, what can you do with your Australian dollar in Australia after you have exchanged your US dollar? Do you have the same purchasing power? Are you able to afford the same goods, or has the price levels changed? So what we do is we use the formula real exchange rate real, same USD over AUD. Very important, AUD stays here in the denominator, US dollar goes in the numerator. And then Australia dollar, very important, AUD, here it's in the denominator, but because of the formula here, F goes on top. So we type in 10% inflation rate here, 2% here. And then what we see, the real exchange rate is different. It is now 0.701 US dollar per AUD. And it's a bit tricky because usually when we compare exchange rates in point in time, let's say this is exchange rate today and this is exchange rate in the future, on a nominal basis, we would say AUD, because AUD is your base currency, has appreciated because the price currency has increased. However, that's not the interpretation here, because we are looking at price levels, because we take inflation rate into consideration. So how to think about the change is to buy Australian goods, you need more US dollar now, because AUD has higher inflation, which means products are becoming more expensive. And if you use your US dollar to do business in Australia and you include underlying inflation rates, then what it means is the prices in Australia have become more expensive. Therefore, you need more US dollar to buy goods in Australia. Yeah, slightly different interpretation, but I hope it makes sense. Thank you so much for listening. I see you in another video. Bye bye.